Hey everyone, welcome to the podcast. I'm your host, JP Barrick, and this is Digital Gold. Known to many as the Bitcoin Kid, I started mining cryptocurrency out of my parents' basement back in 2013. The goal of this show is to simplify the crypto world and explore how it changes the way the world thinks about money through conversations with thought leaders in the space.
JP Barrick is the founder and CEO of Orem Capital Ventures. All opinions expressed by JP and podcast guests are solely their own and do not reflect the opinions of Orem Capital Ventures. This podcast is intended for informational purposes only and should not be relied upon for investment decisions.
Tony Nash is the CEO and founder of Complete Intelligence. Using advanced AI, Complete Intelligence provides highly accurate market, cost, and revenue forecasts fueled by billions of enterprise and public data points. Previously, Tony built and led the global research business for The Economist and the Asia consulting business for IHS. He has also been a social entrepreneur, media entrepreneur, writer, and consultant. I'd like to welcome Tony Nash to the show.
Great. Thanks, JP.
Tony, as I mentioned, you're the founder of Complete Intelligence. Can you tell me a little bit more about what Complete Intelligence does and how you work with your clients?
Sure, yeah. As you mentioned in the intro, I led global research for a British firm called The Economist. And I led Asia research, Asia consulting for an American firm called IHS Markit. In that time, over about a decade, I had a bunch of clients come to me saying, we have two problems. First, forecasts are terrible. And that was a comment both on the work of the firms that I worked with, as well as just the market generally. And they said, forecast error rates are terrible. There's no accountability of the forecasters and nobody tracks their historical data. So we have to try to dig it out ourselves. So forecast accuracy is a huge issue. The second issue is the appropriateness of a forecast. So if you make a chemical or a mobile phone or cake mix, there are specific items within that product that you need to know the cost of, but you may not be able to do that internally. Most companies have, major companies have hundreds of Excel workbooks floating around with their forecast for sales or for costs or whatever. And it's just really confusing. So what ends up happening is people kind of manually estimate costs and revenues. And so what we wanted to do was automate that entire process company-wide. We wanted to take out the human bias that comes with the forecasting industry and internal forecasts and all that stuff. And we really wanted to build products that allowed the machines to learn how markets move. So that's currencies, commodities, equities, and so on, as well as how company revenue and spend changes over time.
So when doing some of my initial research on Complete Intelligence, basically, just to paraphrase, you guys are taking the spot of what an analyst would do. Is that correct?
Yeah, but here's what we don't do. We don't put together a report on what's going to happen in industry X or with commodity Y. Because what we find is when that stuff is put together, so when an analyst puts a report together on some aspect of an industry, it's really loaded with a lot of, let's say, a house view on something or a personal bias. And so we do have a weekly newsletter and we do kind of video podcasts, that sort of thing, but we don't have industry notes because we don't want our clients to feel like we have bias towards, say, the oil and gas sector or toward industrial metals, or that we're for or against gold or for or against crypto or something. There's so much of that loaded into forecasting today, and it has been that way for decades, that we just want to let the data and the sophistication of the data. We're doing billions and billions of calculations every time we run our process. Humans do this, but they're not aware of it. But humans also aren't aware of the amount of bias that they put into their calculation. So what we do is we track this, and we track it based on error rates, and we allow the machines to correct based upon how they've made error over time. It's just like an infant learns, right? You touch a hot stove and you learn not to do that again. It's very similar the way we kind of reinforce the behaviors that we want within our platform.
I guess my question to you is when it comes to these machines, they're learning in the background. So you don't have a team of 1,000 analysts. Instead, you have a team of 1,000 neural networks or machines basically working for you, running these calculations 24/7 on all these different commodities.
Yep.
And are they just making assumptions and then confirming if those assumptions are right? And then the models that do better, end up kind of getting weighted more? How does that work, I guess? How do those questions and answers work in those data testing points, those A/B testing that you mentioned?
It's a good question. So we're running tens of thousands of scenarios for everything we forecast, every time we forecast it. And then we're looking at which ones best reflect the market as it stands right now. And then we, add in the different approaches on a weighted basis to make sure that they reflect where the market is. So it's a multi-layer analysis. It's not just a basic kind of regression, correlations driver, that sort of thing. We're also looking at the methodologies themselves. Some of these are very fundamental, traditional statistical methodologies. Some of them are more technically driven, say decision trees, those sorts of things, types of machine learning models. And we're looking at how, on a proportional basis, those different methodologies best understand the market at this point in time. And so, yes, that's a long way of saying yes to your question.
No, I think that was a great answer. So you guys are looking at currencies, equities, and in July, you discussed gold and silver being nature's Bitcoin. Can you explain to our listeners what you mean by that and provide your thoughts on Bitcoin as a store of value and where you see that blockchain space going?
Well, I think, one of the key aspects of cryptocurrencies is that there should be a fixed amount of it. If it really is immutable, then there's only so much of it. And if there really is demand for something that's limited, then the value should rise or fall based upon the availability of that fixed good, right? Gold is similar in that I can't necessarily go out and buy a car with gold. I'm sure I could. I can't buy a loaf of bread with gold. I think cryptocurrencies is becoming a bit more spendable than precious metals, a bit more useful depending on which cryptocurrency you're looking at. But yeah, it is similar in that cryptocurrencies to date have been more of an asset than a currency. They've behaved more like an asset than a currency, meaning the value goes up and down pretty dramatically based upon the perception of scarcity. Currencies don't necessarily act that way. Currencies act as units of value so that you can buy other stuff. And so, gold is on some level kind of nature's Bitcoin or nature's cryptocurrency. But I think we're coming to a point where there's a division between those two, where cryptocurrencies are starting to be used as, and when I say starting, of course they have already been, but more broadly be used as vehicles to buy other stuff, not just stores of value. So the former is a currency, the latter is an asset.
Yeah, I definitely agree with you on that point. As we move down this line of utilization, we saw with the PayPal news that recently came out, Square news, hopefully people will start using Bitcoin more as a day-to-day currency. It's one of the biggest, questions I get is, it's too hard to use Bitcoin, or when am I going to use it at the store? Less of actually Bitcoin as a store of value, especially from some of the retail clients coming into this space. So regarding Bitcoin and complete intelligence, are you guys forecasting anything in the digital currency space? Are you forecasting the currencies themselves, maybe the mining profitability or any of the mining machines? And can you speak a little bit farther on that?
We do. We started forecasting limited cryptos about 6 months ago. And as I'm sure you can imagine, there's been a lot of volatility in cryptocurrencies over the last couple of years. And because we're a machine learning platform, it takes a while for the machines to understand how cryptocurrencies trade and move. And so just because we started forecasting cryptocurrencies doesn't necessarily mean that we would recommend people making trades or taking positions based upon what we forecast. It's different for things like, copper or whatever that we've been doing for a long time. And those are also relatively stable markets, say industrial metals, that sort of thing. But cryptocurrencies, very volatile, very new, and the market is still learning how to value them. This is one of the key things about cryptocurrencies that I think is misunderstood, is the market is still learning how to value them. That's not a comment on whether I think they're undervalued or overvalued right now. I just think the market isn't really sure how to value them. And so, in our platform, we expect it to take really another couple months before we're confident in where our platform is saying cryptocurrencies will go. Again, because it's such a complicated asset in the way it moves, and because there's so little institutional and historical knowledge about it, we have to iterate it, a couple billion more times for us to really understand where it's going.
Are you seeing a lack of data or trading data, network data in making these decisions? Is that making it harder than traditional markets? Or have you seen that the data in the Bitcoin space is relatively open and well established?
I don't really see an issue with data. I think part of the problem with cryptocurrencies is that it doesn't really trade on fundamentals. So what we're utilizing is a configuration of methodologies that balance out fundamentals and technicals. Some months certain assets lean more toward technicals. Some months they lean more toward fundamentals. Cryptocurrencies don't really have fundamentals to lean on. And so then you're looking at a lot of relatively short-term and ultra short-term approaches to understand the value of something. So the memory of the price, it's either sticky or it's not. And I know that sounds a little bit silly, but cryptocurrencies move in bursts or they languish. There's really not a lot of in between. And so understanding which technical approaches to take and within what configurations to take them is what's really kind of confounding our platform right now. And I would say our error rates for cryptocurrency is probably, I think, 3 times what our average error rate is. So our average error rates for across our assets on an absolute percent error basis is between 5 and 7%, something like that, across currencies, commodities, equities. For cryptos, we're looking at probably a 15-ish to 20-ish% error. And so it might be a little bit lower than that now, but it's settling within a range that we're comfortable with. We're really comfortable when things are, say, less than 10% error. And we expect to be there, very soon. But part of what's different about what we're doing is that we're not afraid to talk about our error rates. We'll be very transparent with people about what our current and historical error rates are and have been, because our clients are making decisions based upon the data that we bring to them and the forecast that we bring to them. So when I say to you, look, our error rates for cryptocurrencies is between 15 and 20%, I'm not really sure you can find many other people who would admit that publicly. But if traders are making decisions based upon the forecast that we bring to market, then they need to know that, right? They need to know how to hedge against that error range.
And so you're referring to the cryptocurrencies are much harder to predict. Is that keeping any of your current clients from moving over to the digital currency space? Are they looking at this space for growth opportunities or for potential revenue generating opportunities or even a way to hedge from the current macro environment?
I think everyone is either involved and trading, let's say, even at a small level, or they're very committed. I think the approach that we've tried to take, there are a number of firms that get very hypey about cryptocurrencies and almost feel like they're trying to push it onto their clients. We're not that way. We don't care if someone invests in iron ore or invests in cryptocurrencies. It's really what is their profile and how well can we forecast it. But I think the interest in cryptocurrencies obviously is still very high because nobody really knows what's happening there. Nobody really knows what the future is there. And nobody really wants to miss out. Actually, I know maybe 2 or 3 people who want to miss out on that and aren't interested at all. But very few people want to miss out on it. And so they're keeping an eye on it or dipping a toe in if they're not already in a big way. And I think, you have to be fair on these sorts of things. It's not as if, say, the main cryptocurrencies have kind of fizzled out. They're still around. They didn't fizzle out after, say, 2 years. They're still around. People still trade them. You're still trying to, we're still trying to figure out how to get them into some sort of monetary system or some sort of transmission mechanism. And until that's figured out, I think that, unless they fizzle out, the main ones, I think it's still necessary to stay involved. So we're not seeing a massive demand for what we're doing in terms of forecasting. And when I say forecasting, I'm not talking about the next, say, 5 to 7 days. I'm talking about the next 12 months, okay? Monthly intervals over the next 12 months. So for something like cryptocurrencies that have a relatively short-term horizon, because it has been pretty speculative from an investment perspective, it's been pretty hard to look at this stuff over a longer term. But we're getting better at it. And I think as these things become more predictive, there will be a lot more interest. And that's largely the market coming to agreement on what the various cryptocurrencies are actually worth.
And following up on that, how do you value them? This being a common trend, it seems like in the analysis that you guys are doing, as a large Bitcoin miner in this space, we believe the stock to flow ratio is a huge component of giving value to underlying cryptocurrency. And so that is when the halving occurs. Did your models take that into account, or how do they kind of work with that event? Because I think the halving is an event where you don't really have that in any other industry, where you're losing half of your new coins coming in or half a new supply coming in on a daily basis.
Well, I think you do see this a bit with, say, central bank money supply, that sort of thing. So, and you do see, let's say, with the dollar or the euro, or the Japanese yen or something like that, you do see central bank money supply coming in, and the pickup of that money supply is not fundamentally dissimilar from cryptocurrencies. Although I think with cryptocurrencies, it's a fair bit more technical. But I think it's, understanding both the stock and the flow is critical to understanding where that value is. If there's too much stock, then, it's obviously not valuable unless there's the demand, the flow going into demand. So yeah, I think but until people can have a normalized discussion around it, where it's similar to, say, central banks, then I think it's really hard for people to contextualize within their kind of trading and valuation framework. So look, if you look, for example, the Chinese government introduced this coin into Shenzhen a few weeks ago, right? They effectively gave people the equivalent of $30 in this Chinese cryptocurrency to spend, and then it was gone. So they're calling that a study on how widespread adoption of cryptocurrencies will work, and I'm sure it was gone within a day, right? I mean, if I'm given $30 to spend for free, then I'm going to spend it probably today. So, I think until we have a better baseline for widespread adoption, and I think the government endorsement on some level kind of matters, because let's look at that $30. It's effectively like a voucher or a gift card, right? That they've given people. They gave people a $30 gift card for free. It doesn't matter what currency it's in, okay? It's going to get spent, right? I don't necessarily think that that's a valid test of the adoption of a cryptocurrency. I think you have to have something more widespread and more enduring, because there you have a fixed amount of stock that's spent over a very abbreviated period. Doesn't really mean anything, right? But I think until we have a wider spread adoption for spend, we're not necessarily going to get a fundamental based value. Okay. We'll get that technically based value, meaning looking at the stocks and the flows and trying to understand based on stocks and flows, but not necessarily based on the inherent value that you get with a legit currency. Not that cryptocurrency is illegitimate. That was probably a bad word choice, but let's say a central bank endorsed currency. We'll say that much.
And on the central bank endorsed currency kind of chain of thought, when you see the United States and Europe and also China adopting these different types of cryptocurrencies, or I guess you could say ways to distribute capital to individuals for stimulus, how are you seeing China and the US and any other major players kind of deploying these central bank currencies over the next 2 or 3 years? As you did mention, China is already doing it. In the US, I'm not aware of us doing any type of central bank currencies or deploying central bank currencies to citizens. But are you seeing, I guess, how do you see that playing out over the next 2 or 3 years, if not, and maybe longer?
Sure. So the China Central Bank did a first test of a cryptocurrency, I think in January of 2017.
Oh, wow.
So they've been trying to figure this out for some time. And I think China sees it as a potential way to rival the US dollar. The problem is there is no trust in the People's Bank of China. Nobody outside of China really trusts it. Okay. So the immutable aspect of a cryptocurrency doesn't have validity outside of probably the walls of the People's Bank of China building. And without that kind of limited supply, without the immutability of it, then again, it's just a gift card. It's just a voucher. Now, I think the PBOC, the Chinese central bank, has had, but with each day it's kind of passing, I think they've had an opportunity to utilize cryptocurrencies for things like trade finance, which is a really opaque aspect of international finance related to trade. And if they had, let's say, gone to some of their trade partners and said, look, in Europe or the Middle East or somewhere, we can get around using the US dollar by utilizing this digital, Chinese yuan or something. I think there was a time when people would have been open to it, especially if it made payments faster and less costly. But I think that window has passed, at least for now. I think it's really hard for China to insert itself. I think if they had done this, say, in 2015-16, I think they would have had a real opportunity, and they could have done a lot to displace some US dollar denominated trade finance and probably displace a lot of euro denominated trade finance. But they didn't do it. They'll keep trying. I'm not sure how successful they'll be outside of those places that have to trade with them, meaning North Korea, Iran, and those sorts of economies, Venezuela, and so on. With Europe and the US, I don't think the central bankers fully understand what a cryptocurrency is. And I don't think that they really have, say, the patience to understand how to, say, deploy it in a credible way, if that makes sense. And so I think you'll almost have these parallel currency regimes with cryptocurrencies. The problem, though, is I don't necessarily, at least for the next few years, see them displacing a currency like the dollar. They may displace, say, secondary or tertiary currencies within, say, international trade, trade finance, cross-border payments, these sorts of things, and even domestic payments where, say, a central bank doesn't really have credibility. That makes a lot of sense. But I'm not necessarily sure that I see it displacing, say, US dollar or euro transactions, let's say, in kind of main, say, kind of day-to-day activities. If you look at a government like Venezuela or Turkey or something like that, where you see a real currency crisis, I think it's possible. I'm not necessarily saying it's probable at a place like Turkey, but I think it's possible that you could see adoption of something like cryptocurrency, especially if the government puts a restriction on US dollar use.
Tony, do you see, it seems like you're saying that the Western, China will have its own central bank digital currency, and maybe the United States will try to deploy theirs as well. Do you think this is going to move the global economy into being a more closed system? Or do you think this will actually open up finance and trade and make it, better for everyone? Or do you think we'll end up having this almost finance war of, we already do have that, but like on the digital currency level now, where it's traceable and trackable by a single entity, and the capital or the cost to deploy these systems is much lower?
It's a great question. I think the people who accept the digital Chinese yuan are going to have to decide if they want a centralized authority in China tracking all of their activities in that digital CNY. I think that's a real decision and a real trade-off that those people who trade in that currency are going to have to figure out. although dollars are traceable, you can kind of transmit them, and other currencies, you can kind of transmit them. I wouldn't really say in an anonymous way, but you can kind of get around tracking of every single transaction. But with cryptocurrencies, the ledger tracks everything. And so if you have, say, the PBOC in China tracking every single transaction for every single digital CNY that's out there, that's kind of next level of information out there, right? It's not just Google understanding what's in your email, and it's not just Alexa tracking what you're saying. It's every single penny you put out there being tracked by a central ledger.
And I think you said that perfectly. China will be tracking every transaction, and that will help these central bank digital currencies. If it's China, if it's the U.S., if it's somewhere in Europe, and as these different currencies are deployed, they'll really be able to build almost a very well put together social graph of who you're paying. I mean, it's very similar to Venmo, when Venmo had the kind of privacy era when you could see every transaction. If you had your transaction on public, that you sent to all your friends.
Right.
This is almost like that, but the central bank can see that for every single person. Now we know who interacts with who, where you go. If you're getting a coffee at Starbucks every morning, where you're going to be. It's very interesting to see the amount of power that these central banks, in my opinion, are going to gain over deploying a currency where it's traceable, trackable, and it's on a single ledger.
Right. Well, also imagine, right now we have macroeconomic data releases like gross domestic product or industrial production or retail sales, those sorts of things. Imagine, right now, the way that happens is a statistics ministry does an estimate of what that economic activity is. And they release it like a month after it actually happens. And then they revise it 4 times before they finally give up and say that this macroeconomic variable is finished. If you do have a centralized kind of ledger for this stuff, you can actually look at national and global economic activity on a real-time basis, right? So you can actually see through COVID. You could see the US economy declining on a real-time basis, or the Europe economy declining on a real-time basis, which would be pretty scary actually, but that's the reality of it. If you have this centralized ledger, you can see, let's say, the velocity of that currency grinding to a halt as people don't spend money, which from a central bank perspective can help you understand how to incentivize people to spend money if they have it. So from a kind of centralized monitoring of the economy perspective, I could see that being beneficial. From a consumer and an individual saver spender perspective, I can see that being a little bit scary.
It is a little bit scary, but I agree with you also with the COVID situation. The stimulus really, in my opinion, didn't get to the people as well as it should have. And central bank digital currencies will allow these central banks to give stimulus to those who are most affected, at least in theory, and to be able to provide potentially different access to credit for different types of individuals who are taking different types of risk, being business owners or just employees. On the COVID kind of analysis, and as you guys with CI were doing the analysis on the equity markets and oil and different types of currencies, did you guys see any indicators, as COVID was picking up in the analysis of the market, and how did it affect your predictions in these, kind of broadly over the different markets that you guys predict and watch?
I think what we saw in the wake of COVID was, and this is no surprise to anybody, I don't think, is a move to very short-term thinking. What data points are coming out, what's moving, what are people doing? Let's track day to day what's actually happening. Also, an eye on kind of what is the government doing? What stimulus is coming out? When is it coming out? How much is it? Where's it going? That sort of thing. So I think for the probably 3 to 4 months, I would say until July or August, a lot of trading and forecasting was really done on that basis. Kind of the news moved the market. It was fear and news that really moved markets. And we had to come to a place where the size of the dump truck of stimulus was bigger than the fear that people had of COVID. And when we got to a number big enough, you started to see markets break higher, which was, I guess, a positive thing for people who weren't working, but getting stimulus from government so they could kind of day trade and make some money in markets to shore up some of their bills. now that the stimulus has gone out, and now that we see at least some markets coming back to, I wouldn't say normal, but at least to a significant level, we're starting to see, or we've started to see over the past, say, 6 to 10 weeks, more fundamental basis put into markets and put into some of those value decisions, whether it's an equity or whether it's a commodity or something. It's still playing out in a number of ways. A lot of the tech's still very sentiment and stimulus based. We see things like, some of the commodities that are still very much based on that, or I would say kind of more than 50% based on that. But we're starting to see markets move back into a direction that's a bit more traditionally based. And I use that term very loosely, traditionally based, but with at least a bit of fundamental analysis. But, look at something like Tesla, for example. The price to earnings ratio is around 1100, I think, something like that. It's just, you may love Tesla, but that's a pretty healthy multiple, right? So, at some point, and I'm not necessarily predicting Tesla will fall to earth, but at some point, something will catch up with the valuations of these things, whether they're commodities or whether they're equities, and we'll start to value things on a more traditional, again, that's a loose application there, but on a more traditional basis.
One of the things that I've been noticing in just conversations is it seems like the stock market is almost, I would say, really turning into a casino where you have people just buying stocks they heard on the news. They're getting the Motley Fool every week, and they have so many decisions to make, so many different options. And I've noticed that it seems to be just too complex for, I would say, normal retail Robinhood traders. They get overwhelmed with so many decisions. I think one of the nice things, about value, as we talked about value in crypto, is at least with Bitcoin, you know what you're getting. You know that this is an asset with a stable monetary supply, with a stable issuance rate over the next 100 years. What are your thoughts on how Bitcoin mining? I'm actually going to change it up and move to a different topic. But what are your thoughts on Bitcoin mining and how it relies, on the global supply chain? Starts in semiconductor factories in China, and you mentioned the supply chain optimization a lot on your website as a function of complete intelligence. Can you walk through a little bit how you guys optimize the supply chain? And then I'd love to talk with you through potentially how the Bitcoin mining supply chain works on our end and see where optimizations are and how COVID or any of these other things impact supply chains and what you guys are seeing on a worldwide basis.
Sure. That's great. I think with any supply chain, you have really three factors. You have cost, you have distance, and you have time. Okay. And so, there's quality as well. But if you assume, that you can get equal quality in multiple locations, you have cost, distance, and time. And so we help people initially with cost. Okay. We're helping them to kind of arbitrage the best cost locations. We have a client who manufactures confectionery. They make candies and sweets. And they buy sugar, I think, at 8 different places around the world. And so we help them understand where the sugar price is, because there's not a single global sugar price, right? There are local factors. So we help them understand where sugar prices will change and at what magnitude they change, so that their factories can be prepared and that they can have the right margin they need, so that they can take in the right inventory, so that they can make the right transactions at the right time. So I think from a pure cost basis with commodities, for example, like sugar, it's possible to do that. When you look at something like semiconductors with a very sophisticated manufacturing process, cost is probably not the only, I can assure you, it's not the only factor associated with the decision. So then you start looking at things like time, and you look at things like distance. And so when we go back to, say, March, April, May, a lot of semiconductors travel by air, and we had air freight rates from Asia to the US that were normally, say, $1.50 a kilogram, that had in many cases been jacked up to, say, $15 a kilogram, so 10 times or more of the normal price. So that's where distance becomes or let's say cost becomes a function of distance, right? And so that chipset, that semiconductor may cost the same ex factory, but getting it to the destination is increasingly critical and increasingly costly. So that's where we help people also to understand what the cost of that distance is and what the cost of that time is. Because you could put it on a vessel and you could ship it and it could take 3 weeks to get where it needs to go. But in many cases, the cost of the finished goods are high enough that you can absorb some of that transport cost. Okay. So there are a number of ways that we help people understand those transactions. But at the end of the day, it all has to do with the cost of that bill of material, meaning the cost of the goods that go into that finished item that's ultimately sold to a customer. So when we look at semiconductors, for example, and you look at what has happened over particularly the last year, and if you look at, say, TSMC, Taiwan Semiconductor, moving one of their locations to, I think it's Arizona in the US, we're starting to get more of that high value supply chain in the US, more as a function to de-risk supply chains in the wake of COVID, meaning factories in China closed during COVID. People still had to make stuff and they had to still have their business open, but they couldn't because the factories in China were closed. Once the factories in China opened, there was constrained transport capacity, so it would cost them a lot more. So they had goods that were late and they had goods that were a lot more expensive than normal. And so I think what a lot of manufacturers have done, especially in the wake of COVID, is said, look, we need to diversify our supply chains and have multiple sources for some of these high value goods. And we, Complete Intelligence, have been talking about regionalization of trade since 2017. We wrote about it more formally in, say, starting Feb of 18, when the steel and aluminum tariffs were put on by the current administration. But we've believed for years that we would start to see a regionalization of trade, and that cuts out some of the risk associated with supply chains, and some of those costs, maybe transport costs that may be lower, are offset by maybe marginally higher, say, labor or taxes or something like that, either in the US or Mexico or something. So one of the things that many people don't necessarily understand is when China came into the WTO in 2000, the US was in the first decade of the NAFTA agreement, the North American Free Trade Agreement. At the time, there was a lot of manufacturing for the US done in Mexico. Part of the reason a lot of factories moved to China was because electricity in Mexico was really, really expensive at the time, okay? And the electricity in China was really cheap. So a lot of these manufacturing, especially energy-intensive manufacturing firms, moved to China to save on their electricity, which was a large factor within their total cost. So what's happened in Mexico over the last, I think, 4 years is laws were passed to deregulate the electricity market in Mexico. So now you have power in Mexico that's a lot cheaper than it was 15, 20 years ago. So the attractiveness of Mexico as a location, at least from a cost basis, is quite a bit higher than it was in the past, and especially quite a bit higher than it was when firms were leaving Mexico to go to China.
So, Tony, you mentioned the impact of COVID on these supply chains, and I want to talk a little bit about something that we have in Bitcoin mining called the supply gap. And it basically, what that is when the price of Bitcoin is skyrocketing and is hitting an all-time high like it did back in 2017. The underlying value of these Bitcoin miners really relies on the profitability of those machines, and that is heavily relies on the price of Bitcoin. So what we see is that these supply chains they shrivel up almost. There's being able to order machines over a 3-month period, it ends up going out to 6 months. You won't be able to get machines until 6 months later. Do you see this not centralization, but going from globalization back to Mexico, back to these localized economies. Do you see that helping these kind of massive supply fluctuations or kind of, I guess, events that occur specifically, with Bitcoin price and Bitcoin miners, but I guess also globally with events like COVID that really do shock the system we know of today?
Yeah, I do. I think that, of course, we're going to have some difficulties in the early days of it. We're going to have some awkward moments where things don't work as people plan, that sort of thing. Whenever you have large systemic change, you always have some moments that are a little bit embarrassing and cause you to second guess the decision. We're going to have those. That's normal. But I think over time, what we're building is a more robust global supply chain. Something like 40% of all manufactured goods are made in Northeast Asia, China, Korea, Japan. And as we have regionalization of manufacturing, and that's to North America, that's to Europe, and so on, we have a diversity of manufacturing locations. And so if there is, let's say, COVID in China or in Asia, but it hasn't hit the US yet, then it's possible to use additional capacity in, say, US or European factories to help meet the needs of Bitcoin miners, right? Depending on what we're doing, depending on the sophistication of those factories and the capacity of those factories. But I believe that as we have regionalization of supply chains, you have much more robustness in those supply chains. I also think that in the wake of COVID, so I lived in Asia for 15 years. I just moved back to the US in 2017. I lived through probably 5 or 6 pandemics in that time. And so we got a little bit used to it. In the US, it's relatively new. And I think people here are trying to figure out how to contend with it. And kind of the calibration of risk in the US to pandemics it's new. So people aren't really sure what it means or doesn't mean. So, the global transmission of viruses is not something that's really going away. So will we have more COVID-like viruses coming out of Asia or coming out of Europe or the US? It's likely. And so we're at a point where we have to have regionalization of supply chains. So first, we have robust supply chains where we can source from the US, Europe, Asia, wherever we want, as capacity, as demand, and as costs require. But also, we have the flexibility if there is one of those events, whether it's a disease event or whether it's, let's say a war or something like that, we have the flexibility to make stuff in other parts of the world too. So if there was a devastating conflict in Northeast Asia today, global supply chains would be paralyzed. That's just a fact. And so the sooner we can get regionalized supply chains, the better we're all off, because the risk of let's say a conflict in Northeast Asia, if it ever happens, it won't impact everyone on the planet as much as it would.
We definitely, I agree, are seeing that de-risking, and big, huge news with the semiconductor and TSMC moving to potentially the United States to build a facility, hopefully reducing on that distance for Bitcoin miners specifically. I found it very interesting that you mentioned about Mexico and the electricity prices there, to understanding that those manufacturers actually had to leave Mexico and went to China because it was too expensive to extract or to complete that manufacturing process. I view Bitcoin mining as a way to almost extracting Bitcoin from the network through a manufacturing process where we're using these Bitcoin miners and large amounts of energy to do just that. And so I wanted to talk farther about how you've worked with clients in either the natural gas or the energy sectors in the United States specifically, and pricing out those markets. And where do you see the future of this industry going? The electricity market specifically, and the cost of power in the United States.
Sure. So I'm in Texas. The cost of natural gas is very low, and the abundance of natural gas is very high. So electricity prices, to be honest, is not really something we worry about here. I know in other parts of the country and other parts of the world, it is a worry. Electricity is something that has kind of always been very regional, and it has always been very feedstock specific. If you're burning oil to make electricity, or coal or nuclear or whatever, and you really have to look at that blended cost, right? But in Texas, we're looking at a lot of natural gas to fuel our electricity. So not that much of a worry for us. And in this region, it's not that much of a worry. I think in places like Europe, where they're net gas importers, I think it's more of a worry. And there's always a lot of discussion around importing gas from, say, Russia or from the Middle East or from the US. I think they have an abundance of choice there, but it's relatively more expensive there than it is, say, here in the US. I think in Asia, you have a lot of imports from the Middle East, particularly places like Qatar, these sorts of things for natural gas. China uses a lot of coal, something like 70+% of their power generation is from coal. And it's really hard to wean themselves off of that. Japan is a very large LNG and natural gas importer because they shut off their nuclear power after the incidents in 2010 or 2012, with the reactors, the Fukushima reactors. So, it really all depends on the local power generation capacity and feedstocks. But I think generally, we're not necessarily seeing a world where hydrocarbons become all that expensive for quite some time. When we look at what COVID did to demand, the demand destruction that COVID brought about is pretty shocking. That applies to industries and that applies to consumers. So we don't see, say, oil prices or natural gas prices hitting, let's say, the highs of 2008 for quite some time. And, since they are relatively global commodities, although there are differences in certain aspects of them, it also pushes down the prices, let's say, in other parts of the world, say the Middle East and so on and so forth. So we don't see electricity prices outside of, say, regulatory impacts or things like fixed investment requirements. So let's say there's a regulatory requirement that a power station can only be, say, 20 years old. That's a significant cost that would add to electricity prices. But other than that, it seems to us that the feedstocks, although we don't necessarily expect to see kind of negative $37 oil like we saw in April, we don't necessarily see energy price inflation coming anytime in the next, say, 24 months. And if we look at things like gasoline, I know this isn't electricity, but things like gasoline, prices are down, say, 30% from where they were a year or so ago. And they're expected to remain that low, at least for the next 6 to 12 months. So it's not just electricity, it's also gasoline or petrol as well, where because of muted demand, prices will remain relatively low.
And I think that's great news for miners in the United States and really across the world as more and more energy generation comes online. We're seeing that cost to produce coins is continuing to get cheaper, and which allows miners here in the U.S. to compete, if not beat, miners in China on the cost per kilowatt hour. Tony, was there any other trends that you guys are focusing on right now in regards to your investment portfolio analysis that you wanted to highlight on the show today?
JP, I think there are hundreds of trends we're following, but I think we've cut most of the main ones. I think really it's understanding risk of any asset that we follow or our clients follow is really, really important. Whether it's cryptocurrencies or whether it's oil and gas or whether it's, the S&P 500, understanding the risk there is really critical. We're always trying to figure out how to balance the risk and opportunity associated with the assets that we forecast. And that's, I would say for any of your listeners, that's the really critical part to understand. So, we could pursue this down any avenue. And I'm sure we could talk for another hour on just about any asset. So I really appreciated the time today. It's been a fantastic discussion. Thank you very much.
Yes, thank you, Tony. It was great to have you on. I want to offer you the opportunity, Tony. Do you have any questions that you want to ask me about Bitcoin mining specifically that you want the audience to make sure they hear? Anything that's on your mind?
I guess what I am curious about Bitcoin is, we saw a bump in 2017, I think largely driven by broad awareness or a more broad awareness of the opportunities in Bitcoin. What will drive the next bump in Bitcoin or crypto value? What do you see driving that next rise, let's say 30 to 40 to 50% rise in the value of cryptocurrencies?
So the way I view the cryptocurrency market and really Bitcoin specifically is I'm all about the stock to flow ratio and how that Bitcoin is created. So when that halving event occurs, I got into cryptocurrency back in 2013. So I've been through two of these halving events now. And when that halving event occurred in 2016, we see that it kicks off like a real almost momentum moving into the space where the cost of creating these new coins is exponentially higher, makes it so that all these older machines have to come offline. And it really does a disservice or really degrades the value of these mining machines. It makes the profitability cut in half. And so when that happens, I think that the lack of coins, new coins coming into the system creates the momentum which is needed to push the price up to those 2017 highs that you were talking about, or potentially 2021, 2022 highs. Simply saying it doesn't happen instantly because it does take a while to get there, but I expect that to happen in the next coming years, not necessarily because of one event, but simply because of the schedule of new coins coming out onto the market.
So, sorry, if I understood you correctly, are you also saying that the age of the infrastructure that the miners are working on has an impact on so the replacement cost of that infrastructure also puts upward pressure on the price of Bitcoin?
I would say that exactly. So the fact that we have to replace machines that have less efficiency, so the joules per terahash or how well they can turn 1 watt of energy into 1 terahash of mining power, needs to be upgraded by 50%. So if you have a machine that was running 100 joules per terahash, like the S9, that machine's no longer, and it was just barely making money, that machine's no longer going to be even anywhere close to profitable because of this halving event. You now would need to go upgrade all of your machines so that they run at the 50 joules per terahash level. Or you need to find half the cost of electricity. And that is very hard to do, especially because these facilities are massive with hundreds of megawatts of power. Mm-hmm. So that's what I drive as the underlying driver to this Bitcoin price push that we see every 4 years. And if you look back on the chart, it happens every 4 years simply because the miners play they're one of the biggest components of the ecosystem. There's about $5 billion in mining rewards today every year. And that's a huge driver in a relatively small market where Bitcoin is currently sitting.
Interesting. So that replacement cycle, like you said, and this is a question, it's not a statement, that's about every 4 years, give or take.
Every 4 years, give or take, you either have to replace your equipment with newer machines, which now you're waiting in line because everyone else in the whole Bitcoin network has to do that, or you're moving to power where it's half as expensive. But all miners are always searching for the cheapest power. So that's something that's always occurring.
Okay. So with the kind of the supply chain hiccups that we saw with COVID, does that push that replacement cycle back? Like, is that replacement cycle being pushed back by 6 to 9 months? So, or do we have a pent up kind of inflation? Meaning, do you believe that the value of Bitcoin being driven up will last for longer because of the supply chain issues we saw in COVID?
So definitely with the supply chain issues in COVID, it affected our shipping rates. As you mentioned, those increased dramatically. It affected how fast machines could get out. It actually caused Bitmain and some of the other major manufacturers to delay their shipping by 2 or 3 months. So if you were to buy a batch to be delivered in November, it still hasn't been delivered. So there is that pushback, and we've seen that greatly affect the market. Regarding the deployment of these machines and kind of scaling with the recent Bitcoin price rise, new machines are very hard to get. I would say about maybe 10,000 to 15,000 new machines per month are coming to the US. And that might be even on the higher range. That's about 50 megawatts of power per month coming to the US and coming out of these factories, which is only $50 million worth of capital. So we have huge constraints on the semiconductor themselves and making those mining machines. And when the price of Bitcoin even jumps up like it has over the past couple of days, up to the 13,000 mark, that's going to create even more external pressure, even more interest in mining, which makes it even harder to get those machines and will push out the timeline even farther. So yes, it's a huge issue when it comes to supply chain management because of COVID and the Bitcoin price increasing investors' appetite to get exposure to this space.
Fantastic. That's really interesting. Thanks for that.
Of course, Tony. Well, thank you for coming on. I appreciate it. And I'm glad we were able to have you on. Thanks again, Tony.
Thank you. Hope to speak soon.
Have a great day.
Thanks, JP. Bye.
Bye-bye. I hope you enjoyed today's episode of Digital Gold. Be sure to subscribe so you're notified when the new episode drops. Don't forget to leave us a 5-star review to support our journey to become the #1 crypto podcast. Thanks so much for listening, and until next time, mine on.